Hello, good morning. It's Tuesday the 13th. I'm FxPlew and this is the market brief. So GDP data show that UK growth is on a knife edge. The economy grew by just 0.2% in July, which was less than forecast, and overall Q3 is still expected to post contraction. As Q2 saw 0.1 contraction, this would mean that we'll be in a technical recession from the end of Q3. And indeed, the Bank of England believes that that will be followed by an ever-increasing slowdown. Their view is that that will last throughout next year. While they're reluctant to use the official terminology, that would mean stagflation is ahead. Recession coupled with inflation. Hold on to your hats. Indeed, we'll see the latest inflation data tomorrow. The headline number is forecast a little bit higher, forecast anything from around 10.2 to 10.5%, but the hope is that the rate of growth will have slowed. Perhaps more importantly, though, is core inflation data, which strips out energy and fuel and food, because that's where the rate hikes should have the most effect. The general sentiment there is it's about bloody time, and it may very well contribute to the MPC voting for a 75 basis point rate hike at their next meeting. Meanwhile, in the market, sterling recovered further. We reached 117.10 against a correcting dollar yesterday, and we open around 115.40 against the euro, and euro dollar is around 101.40 as the ECB's 75 basis point rate hike from last week really beds in. Over in the US, a report has accused the Fed of deliberately targeting job losses to bring down inflation. Now, while it's unlikely this is the main reason for all the rate hikes, it could indeed be an unsavoury byproduct of the policy. The risk certainly increases as future rate hikes should move us past the neutral rate and have more effect in restricting growth. So, do you think we've already seen the low point for the employment rate? Answers on a postcard, please. The Fed has already announced that it will shrink its balance sheet, but there are calls for the pace of that action to be increased. One of the reasons for this is due to continued equity market performance, which certainly suggests that there is still too much money sloshing around the system. And that's one to keep an eye on. Indeed, if the Fed does accelerate the balance sheet shrinkage while moving rates into more restrictive territories, equities may well see a significant correction. And of course, that would be a lot more in keeping with the signs of a traditional recession. Meanwhile, the dollar index is experiencing a deeper correction. That fell to 107.80 yesterday. We recovered a little before the end of the day and we closed around 108.30. Right, that's it from me. Have a great day and do join me again tomorrow.
If you do not have a clue, then just tweet through and ask FxPlew.